Okay, hello and welcome to the first Assess, Measure, Decide webcast, probably the first of many coming from our brand new Concurrent studio. My name is Liz Lenz. I'm in charge of enterprise consulting at Concurrent, and I am joined by two very important and esteemed guests. The first is the CEO, Nate Lenz, and Dave Patchen, Concurrent's executive in residence. Hi, welcome.
Hi.
Glad to be here.
Good to see you.
Glad that you are here. So we have a lot of people attending today, and thank you all for attending the first of many of these series. What you'll find on your screen is a video, a snapshot of some of the visuals that we're going to be using today, and a list of resources. And some of those resources are downloadable PDFs. Some of them are LinkedIn invites, URLs, email links. So we encourage you to use them to reach out to us if you have any questions. And this recording will be available to you and all your friends after this event, so feel free to share it. So without further ado, let's have our guests introduce ourselves. Dave, will you please go first? Please
Sure.
tell us about yourself.
Happy to. Tough topic to discuss. Been in the industry for about 40 years, started as a wirehouse financial advisor, built a book, went independent, ended up helping run and grow that independent firm. That firm cleared through Raymond James. That's how I got to know Raymond James. Before I came to Raymond James, though, I actually left that firm and had my own RIA firm. I cleared through Waterhouse, interestingly enough. That's a name from the past. That was Jefferson Capital Management, and came to Raymond James in 1998 as a recruiter. Ended up in regional divisional management, where at one point I was responsible for half of the country for the independent contractor division, and then spent the last 13 years running PCG education and practice management, where I got to know many of you and helped you grow and make your businesses prosper.
12 of the last 13 years. One of those was with us in the executive residence capacity.
Okay.
So.
Well, no, then that's 13 of the last 14 years.
All right.
Yes.
Fair enough.
Yep.
We're adding to that number now.
Yes.
Great start, guys. Okay, Nate, for those of you that don't know Nate, Nate's the CEO. Please tell us a little bit about yourself. And maybe could you give us a little color on you and Dave? How you and Dave really know each other, how you've met.
No, absolutely. Started in the business on the institutional side, ultimately ended up at Raymond James, which is where I met Dave. Was in a rotational program there that happened to rotate through the regional management structure of the independent broker-dealer at that time. And I'll give them some credit. They had the foresight to understand the need to bring succession planning resources to the field. At the time they were looking at building out that team. And I had the audacity at 25 years old to apply for the director's role. Which I, made it all the way through the interview process, and then was told, okay, well, you're not really qualified, but we'll make a spot on the team for you. So that's how I got to know Dave, is working in that capacity. A little bit of a different upbringing in the business. Grew up on the business consulting, practice management side of the space. Was at Raymond James until 2016. Ultimately, did get the director role. After my predecessor.
And that's how you got to know.
And that's how I got to know
Miss Liz.
So,
yes.
No, it's been and I think that's always been in the DNA of us as an organization. The fact that, I think we do our best work when we can come alongside firms who are at that inflection point, who are thinking about taking that next step of scaling a business from just running a practice, and being able to bring our expertise alongside is what we love doing on a day-to-day basis. So, and we launched Concurrent in 2016. Originally built it as an OSJ on the Raymond James platform, and then launched the RIA in 2022, and subsequently made the transition off. Currently, we're sitting at about 17 billion of AUM. We've got another 18 billion of assets under advisement in our corporate retirement plan business, so about 35 billion of total assets. And it's been an exciting ride. I always love to talk about that clip art that you could find on the entrepreneur's journey, where it's like expectation versus reality. Sure. Expectation's like a nice, steady, straight path up. Reality ends up being you climb for a little bit, you fall off a cliff, you swim across some shark-infested waters. So
exactly. Yeah, I think for the young people in the audience, what's great about the two of you is while you're young, you've spent the entirety of your careers in the wealth management space, understanding everything about a wealth management business, what makes it tick, what makes it grow, what its challenges are, understanding the technological aspects of that. So part of what we're going to talk about today, part of what is so important today is education. It's availing yourself of the knowledge and information that's going to maximize the asset that you work on and that you've been building. And these two are really well positioned to help you do that. Go ahead, Liz.
Well, and I was going to say, I mean, this is intended really to be an educational event. There's so much to learn about our industry and about our space, changing increasingly at an increasingly high rate, not only from my availability of options, but from a technology standpoint, as you alluded to. So, Dave, really first question for you is, when preparing for the event, what were you hoping that the attendees got out of the event? What they got home with, what should they be thinking?
Yeah, great question. It's a corollary of what I've been through the last 15, 60 months hanging out with you guys and working with Concurrent. It's learning. It's learning what all of you know, many of you know, because some of you on the podcast don't know my background or don't know me well, but part of what we teach is what drives change. And 4 words we use are insight, awareness, discomfort, change. Insight is helping people know what they don't know. And what I found in the last 15, 16 months is there was a ton, all this 40 years in the industry and all the work I've done, 8,000 one-on-one hours coaching wealth managers over the past 20 years. There's so much I don't know about this part of the marketplace and what's happening with private equity and the multiples and the challenges for next gen that want to buy into the practice. So that, guess what, folks? Yes, I'm foreshadowing. That's all stuff that we're going to talk about in great detail today.
Well, I think it's interesting, the RIA space, if I think about even when I first started on the retail side of this business at Raymond James in 2011, the RIA space has evolved rapidly since then. You think about things like technology you just mentioned was a huge point of competitive disadvantage. I think that pendulum is fully swung to now it's a point of competitive advantage. And so I do think in a lot of ways, the RIA space we're kind of in the right place at the right time. It's definitely more approachable than it's ever been.
Yeah.
We've seen new entrants into the custody space, like firms like Goldman Sachs, alongside of the incumbents, the Fidelities, the Schwabs, the Pershings. And I do think a move into the RIA space really allows you to become an institutional client of the street versus being captive to a singular platform. And I think that ability to shed the landlord, so to speak, really puts everything at your fingertips. And I think in a post-financial crisis world, clients want more bespoke solutions. They want objectivity. They want to understand that you're sitting on the same side of the table, but they want to make sure that the money's safe, that you have access to the resources that you ultimately need. Yeah. And so, when I think about the space at this moment, and you look at the fact that every advisor, regardless of what channel you're in now or what channel you started in, my belief is an entrepreneur. You're entrepreneurs at heart, right? Yeah. You've built your business pounding the pavement. There's no other way to do it. And so I do think when I think about what advisors are looking for as they evaluate options, ensuring that they find an environment that creates that haven for their entrepreneurship, that supports it, that doesn't ultimately try to disintermediate them from a client, I think that's tremendously important. I also think there's some tremendous macro tailwinds within the RIA space, within the wealth management space more broadly. The idea that there's a rising demand for advice. We all hear the statistics around generational wealth transfer, the statistics around business owners that'll be selling over the next 10 years. It's no doubt that there's a rising demand for advice across amidst a declining supply. So that's a major macro tailwind that we're experiencing. The technology, as I mentioned, that pendulum has swung, the road's really come up to meet us. Mm-hmm. And so now what was a point of disadvantage is now a point of advantage. And I do think the ability to be nimble and move quickly. We all saw the news that came out a week or two ago with Altruist releasing Hazel AI, and I think it broke the internet and also a few of the leading financial services stocks. But I think that's just an indication of what's to come, in that this space is going to continue to evolve, and having the ability to go out and access some of these great tools and resources are going to put advisors in the best position to serve their clients.
Yeah, I mean, same thing happened with May Day back in 1975 when commissions were, discountable. Same thing happened when the internet came out. Same thing came out with robo-advisor. So this is the latest in the never-ending saga of challenges and threats from technology to our industry.
Well, I think it's an opportunity, though, because I'm not a believer that it's an advisor replacement. but it is a way to absolutely amplify the advisor's capabilities.
Absolutely.
Make them tremendously more efficient. You know,
Yep.
there's that McKinsey study that came out last year that said there's going to be 100,000 advisor shortage by 2034. You know, okay, yes, we might have 100,000 less advisors, but I don't necessarily subscribe to the belief that we have to go replace it with 100,000 new advisors. And I think a big part of that is going to be the ability to gain efficiencies through technology.
Yep. Agreed.
And ultimately, when we think about, and we'll get into the landscape here in just a second, the value of alignment is clear. And we'll see that when we start to look at different models, the ability to not just own the clients, own the business, own the enterprise value is monumental. And ultimately, that's what we're seeing as we start to think about valuations, is really moving away from some of the incumbent models to the benefit of the RIA space. So when I say right model, right time, what I really mean by that is now all the options are on the table. I couldn't say in good conscience that, 10, 15, 20 years ago, that it was necessarily the best spot to serve clients. But I can say with complete confidence that it absolutely is, and it deserves to be looked at alongside of
absolutely
the other options that are there.
There isn't a compromise now. Yep.
Correct.
Well, and I have to say, of the number of consulting conversations that you have on a day-to-day basis, and I can speak to my personal experience, says that most of the time we do spend hours asking them about what their business goals are, what their client needs are, how they want to propel the business forward, and then matching that with education on what the affiliation landscape looks like and how to find the right structure, the right partner, the right set of technology solutions that is changing so fast. It's so different than it used to be. My question to you two is, how has the affiliation landscape changed? So walk us through that. And we have a visual here for you all to look at. And by the way, if you all start to have questions, there is a Q&A chat feature if you want to chat in some questions as we go through this, because we're going to be getting into some pretty technical information about what's different in each affiliation model.
Yeah, and I'll just start by saying how custom, bespoke, whatever word you want to use, each of these conversations is. By the way, this is not, while we're looking for people to reach out and connect and show interest, this is not a volume trade that we're involved in here, folks. This is very selective. It takes time. This is not something you roll out of bed and do tomorrow. So know that we understand that. We want you to understand that. There's a ton of variables. What you want is somebody that you can trust, and you want somebody that's knowledgeable. And that's what you've got when you start talking with the Concurrent team. I think that's really the biggest value added is there is no downside, because the least you're going to come away with is a better education.
Yeah, better knowledge. Nate, so walk us through, what are the options?
Yeah. So, and I love this graphic. And when you start to think about the affiliation landscape and you start kind of far left to the most captive employee models, bank models, and you start to move from left to right and think as you go along that spectrum, you start to move into models where you have the ability to solicit clients, right? And they deem that ownership of the clients. From there, you move into 1099 affiliation models where you now own the business. You go from being a W-2 employee of a firm with the ability to solicit clients, which is really what client ownership means. In most cases, devil's in the details when it comes to ownership of data and things of that nature. So it definitely behooves you that if you're thinking about options, to really understand the nature of your employment agreements, what you can take, what you can't take, whether you're a member of the broker protocol or not. All of those are things that you'll want to consider as you start to think about what options might be available to you, and more importantly, what the risk is of those options. From there, though, you start to move into the independent space. And ultimately, you go from, call it W-2 to 1099. You're setting up potentially a DBA entity. You're running a P&L and an expense structure. Yep. You now have ownership of the business. Then you get out into the RIA space, and let's say you're forming your own RIA. Well, now you're fully unconstrained, right? You own the clients and the business, and you now have the ability to go out and raise institutional capital if you've got the scale to do so. Yep. You've got the full menu of investment options at your disposal, the full menu of technology at your disposal. That might not necessarily be a good thing. Dave and I have talked about this in the past, this idea of like a dichotomy of freedom. Sometimes too much choice, is not necessarily a great thing. And so being able to sort through and refine it. But bottom line is, when you get to the far end of the spectrum, assuming you're owning your own RIA and your own ADV, you're fully unconstrained. However, most affiliation options at that end of the spectrum, don't necessarily represent that. And there can be RIAs that are more captive than the most captive employee channels, up to firms that are there purely as a service provider, supporting you in running your own RIA and having your own ADV and everything in between. I know we've got our little logo up at the top in terms of where we fall. Another way to think about this, and we've used this analogy in the past, is if you're sitting in a captive employee model, in a lot of ways, you're kind of living at home with your parents. All of a sudden you get into the independent space. You've got some freedom and autonomy. You've got your own apartment, but at the end of the day, you still have a landlord. Once you get out into the RIA space, again, you shed your landlord. Now, in a model like Concurrent, I would say the easiest way to think of it, if we're following this analogy, is now you've got an HOA. You live in a gated community. You might have better resources and amenities, but you're getting a lot of the same freedom and flexibility as in terms of where we fall.
Yeah, and what I would add just to this slide, a couple of things. I look at this and I want everyone to think about portability and positioning. If you're not thinking about how portable your business is, you need to. How many of you are aware, I hope most of you are aware, that Ken Fisher recently monetized a portion of Fisher Investment Management, okay? What's the reason that you do something like that? Okay, it's because of what's going on in the marketplace right now. The other thing, and geez, I don't mean to offend, I'm just telling you what I've come to, the conclusion I've come to, being 40 years in the business and 15, 16 months into really learning this entire spectrum. And that is, folks, you're a dinosaur if you're on the far left. Are there some of you, very few of you, that it still makes sense for, I'll say, a definitive perhaps, but I just can't think, I believe in my heart of hearts that most of you just aren't aware of how limiting that construct is once you start to avail yourself of the other options along the spectrum.
Hey, Dave, maybe talk a little bit about, we were talking before we got started here on this concept of, I was talking IRR, but you were talking ROR, return on relationship. Maybe speak a little bit to that construct.
Well, that's the way I want our audience to start to think about it. You have a relationship with a business partner. How are you measuring the return on that relationship? And let's look at some of the variables. One variable is you're doing the work. Okay, we all know who does the work. You and the team do the work. You're getting paid for that work. That's another big variable. What is your compensation? What's the ratio? What could it be versus what it is now? And then finally, what's the value of the asset you're building? How many of you, we got some young folks out there, I'm sure, listening in. What's the impact on your net worth to the asset that is your business? These are really important variables. And that's why I make the statement I just made a few minutes ago about being on the far left of this spectrum is, as you become aware of the answers to all of these variables, it just doesn't make any sense anymore. I'm surprised it's still working. I think its days are so numbered based on, it's all about knowledge and awareness, and that's why we're here today.
Well, and I just love that you asked that question, because ROR, new acronym for Dave. Dave loves acronyms, so if you work with Dave, you'll catch a few in the times and that you spend with him. But ROR, I mean, that when advisors are assessing, okay, the return on their relationship about their practice, what are some of the buckets you want them to be thinking of as it relates to their business to make that assessment off of? There was a big three that you've always taught me, and I'd love for you to go over.
Yeah, it's very simple, because I love keeping things simple and high level. The big three are: how do you do planning, how do you manage the money, and how do you manage the relationship? All of you do, and your teams do that in some form or fashion. Even if planning is just discovery and you're basically a portfolio manager, that still is a piece of your business. And each of these has a client experience front stage aspect, as well as a process chassis backstage element. And this is what's so exciting about what you touched on earlier, Nate, and what Liz and team and my old team focus on is, if you become a world-class operator and you start to really leverage technology, you don't need what we're going to talk about in the way of a lot of back office hand holding. I mean, that's what's so amazing to me. Really, the personal computer is what drove the onset of independent contractor 30 years ago. Okay. Mid 90s is when it became possible to run a business from an executive suite, right, folks? Yeah, I think you understand what I'm talking about here. But where we are today is light years ahead of that. And the capabilities and the tools, and now with AI that you have access to become efficient operators, to deliver world-class service at scale. Not only are they like they never have been, but they're getting better every day.
Right.
Yeah.
Another slang from Dave, get better every day. G-Beds, and name of his consulting company, if you should know. But I mean, I think that all those considerations do impact how we think about the value of our business, the economics of it. Nate, could you touch on that a little bit further?
Yeah, let's talk numbers here.
Well, and I think the far left, to Dave's point, right, there's just too much opportunity cost to continue to stay there. And to give a frame of reference, let's pull up the P&L slide. I think that would be a good one to take a look at, because I think this will help paint the picture. You know, at the end of the day, sitting on the far left as an employee, right, you've got your platform, your broker-dealer related expense, and you've got your FA compensation. At the end of the day, they're handling all of the operating expenses. They're curating the tech stack. They're providing the operational support. So again, there's some major convenience.
When you're a startup, absolutely. Yep. There's value there. Yep.
Yeah. And I mean, honestly, when you look at the firms that are still successful in training advisors, firms like Edward Jones, right, that's a great place to start and to have that capability to grow and learn the business. I know you guys started a great, shout out to Matt Ransom on the AMP program. You guys had a great training program at Raymond James.
Elise and the team, absolutely.
And they've had a tremendous amount of success there. And so that framework is a great place to start. However, as you start to build a business, that's where the opportunity cost becomes increasingly hard to overcome.
Especially when you become a true enterprise. Yes, exactly.
And when you think about the ways to realize your enterprise value, right, as an employee, it's really the sunset package that the firm has to offer. So if you're at Morgan Stanley, it's the FFAP, Merrill Lynch had the CTP, UBS has the Alpha program, you know, retirement choice and the Raymond James side. There's a prescriptive program as to how you're able to transact your book with the next generation. It's typically financed out of a split of the grid. Typical valuation multiples range between 1 and 2 times top line revenue. And so great, if money's not an object and you're ready to walk away from the business, it can be a great way to hand it off. But when we look at the realm of competitiveness with other options that are available to you, it's wholly uncompetitive. That being said, you know, a lot of multiples get thrown around.
Yeah.
We talk about revenue multiples. We're already doing it on this slide. We've got multiples of revenue and multiples of EBITDA. So I think it's important to understand what the difference is and how we should think about those two and what are the equivalents. So over here on the right side of the slide, you'll see a P&L of an independent business. And I think it's important to note that we're looking at both a independent practice sitting in the independent broker-dealer channel, as well as an independent RIA. And they look identical. I think that's important. The RIA space is not necessarily synonymous with higher payouts. In a lot of cases, a move to the RIA space doesn't necessarily represent an economic step up, right? It's not that's not the way to think about it. So that's entirely intentional. But when you start to think about a P&L and you go from your gross revenue to your net revenue after platform, broker-dealer, custodial expense, to covering your operating expenses, office space, support staff, and so forth, you know, that's where you get to your earnings before owner's comp or EBOC line. The difference between EBOC and EBITDA is what you pay yourself. Most advisors are the owner and the operator. They're paying themselves compensation for servicing the clients and doing the job, and they're ultimately receiving the profit distributions from the business. A lot of times those get conflated into one number.
Sure do.
You know, so, but I do think it's important to separate the two, especially if you're at that inflection point and you're going from owner operator running a practice to scaling a business. It's necessary to decouple the profitability of the business from the expense of servicing clients, because when it starts to come to creating career pathing and compensation structures for junior advisors, you want to be cognizant of what your EBITDA target is and building your compensation structures to fit.
Sure.
Especially for advisors that are coming in as service advisors and junior team members, essentially farming a book of business that you've already created. But I give you this breakdown so that we can start to see the difference between a revenue multiple and an EBITDA multiple. In most independent firms, they're running at, call it a 30 to 50% EBITDA margin. And so when we look at that range of multiples, which is the typical range of multiples in an arm's length transaction, selling it to the person down the street, if we assume, call it a 40%, EBITDA margin, well, then really, if we're looking at, call it the high end of that range, 7x EBITDA, well, now we're looking at a 2.8 times revenue multiple, just to get into the equivalency of it. So when you think about the independent broker-dealer space, where really the outlet for selling the business is selling to another advisor, another advisory firm, likely on that platform, then typically the valuation multiples that you're seeing for that might be in this 4 to 7 times EBITDA range, or call it 2 to 3 times revenue. And we could talk a little bit, I know later, I think we've got a slide on why that is and why there's some constraints there in terms of value. But that's a good way, I think, to think about at least the P&Ls of a practice and how they compare across channels.
Sure. And, and I would encourage you all to work with and look at your own P&L. Think about what the cost of servicing a client is, the cost of an advisor, because that yellow bar FA compensation where your independent environment can get a little blurry. I work with many solo practitioners that say, well, I pay myself what the CPA says to pay myself for the year.
Social Security wage base.
and that's the cost of my time. As you learn to scale the business, you have to really think about it more strategically. One of the things here is we're living in a world where we've got multiples being thrown around in emails as pitches, and, or someone say 47, man, I heard something, a bigger number than that. What about a 10 times? What about an 11 times, right? Give us some context around industry multiples. What are the factors? Go from there. I
do think multiples have moved, and we are seeing multiples continue to creep up. I think the average multiple for, call it a $250, $300 million practice last year, at least in the fully independent RIA space, I think that's an important distinction, transacted at somewhere between 8 and 9 times EBITDA. Now, why that's an important distinction is because who's paying those multiples, right? Valuation is what a willing buyer is willing to pay, for a practice. And so I do think when you start to look at the firms that are paying those multiples, this is a good graphic. And I think this is, again, kind of bell curve. We're seeing the, actual multiple paid, sellers expected multiple. This data is a little bit outdated in that, we've seen this move slightly to the right. As I mentioned before, I think the average multiple now is between 8 and 9x is what's ultimately being achieved. But the reason being is that you're seeing a shift in the primary suitors for practices. You've seen this rise, and I think Echelon released a 2025 deal study. Excuse me, and over 75% of the transactions in 2025 were done by private equity-backed roll-ups. So these are, the firms that are ultimately taking on private equity sponsors and are going out and acquiring practices in a scalable and repeatable manner. Most of those deal structures are happening in that 8 to 10x range. Typically, they might be maybe it's 7 or 8x in cash up front. There's an equity roll where there might be 2 to 3 turns in equity that's being added to that, but it's creating these extremely high headline numbers, and they're having a tremendous amount of success. As I mentioned, the vast majority of the deals done last year were done by those buyers. Now, why are they able to do that? Because they're not dependent on debt. Right? They're not dependent on the cash flow from that book of business to be able to service the debt that they're taking on. They have equity backing behind them, and ultimately they're able to arbitrage multiples. These are firms that are recapping. They have tremendous scale. They have diverse revenue streams across geographies and client demographics. They've got alignment within their underlying advisors because, again, it's the put on the fatigue, salute the flag kind of construct. But at the end of the day, those firms are powerful buyers, and they are absolutely pulling the market up from a multiple standpoint, which I think is going to be ultimately problematic for G2 advisors. But I think overall, it's beneficial for the space, especially as advisors are looking to either de-risk, if they're looking to help facilitate internal succession, drive growth. Ken Fisher, right? So I think it's overall, the access to capital in the space has evolved considerably, but there's definitely winners and losers in that equation.
Yeah, Dave, what do you have to add to that? Because this is all sort of breaking news a little bit to people that have not been actively looking at that space and reading. I mean, they're reading headlines, but maybe not fully understanding what's going on. So what would you tell to those people?
Well, I think what's interesting that I've learned from you guys and from the seas that Concurrent navigates through these days is the private equity firms and what they're providing and who they're looking for. There's so much variability in what your relationship ends up based on this spectrum. So the Mercers of the world, that's the salute the flag, and they're going to take over, and you're going to be a captive agent to that business.
Sure.
We've heard enough of those. Very few of those have turned out well if you really still wanted to be involved. So how much control are they going to have? What are they going to change? What's going to happen to your team members? So we understand that's why these conversations are so bespoke, that there's a lot of variables that you need to consider. Shopping for the biggest multiple is not what this is all about. It's really, as Liz said earlier, sitting down with you and saying, okay, where are you? Where do you want to go? Based on that, what are the possible options, the possibilities? And, also you keep changing. A torpedo doesn't leave the sub and go straight to the target. You're constantly adjusting along the way. And that's what is going to happen regardless of where you are now. There's just a long journey to get to where you're going to be in the best spot.
Yeah. And I do want to comment on that, because it's even, to your point, there's so much nuance to this. And it's all about finding the right fit for your clients, for you, for your transition timeline. To your point, it's not about just chasing the highest check. Mm-hmm. But even within the spectrum of independence, the torpedoes are constantly moving. Yeah. And we've actually seen that. You brought up the rise of the personal computer, and it made me think of, if we looked at, this year's Nobel Prize in Economics was awarded to a group of economists for their work on what's called Schumpeterian growth theory, or creative destruction. And it's this idea that you have these waves of innovation where it creates short-term monopolies for firms that make outsized profits. There are winners and losers, and that drives progress and productivity growth. And then it gives way. It gives way to homogenization, and then to the next wave.
Exactly.
And we're seeing that with AI. I think we've actually seen that, what's really interesting, in the independent space. You go back to when, firms like early innovators, Focus Financial, Hightower, Dynasty, right? Some of these early players in the independent space that created new models to support advisors and had tremendous amounts of growth. And ultimately, at the same time, you saw the rise of the private equity-backed roll-ups, the Mercers, the wealth enhancement groups, and so forth. Two very different models, right? Some innovators and independents, some building the traditional roll-up model, but the singular firm mentality, singular brand, singular process.
Sure.
And so it's been interesting to see, though, call it over really the last 5 years, as you've seen more capital come into play, where a lot of those early innovators in the independent space have started to homogenize towards firms like Creative Planning, right? And some of these other firms, because they're seeing what's happening in the markets. And I don't ultimately think that's a good thing for advisors. I think that's where there's a lot of opportunity for models like ours, where we can ultimately provide the resources that those firms are looking for, that those large scale firms have. We can keep pace there, but do it in a wrapper where the advisor maintains full control and autonomy.
Yes.
Sure. Well, and to those people that this is a challenge to, we've talked a lot about this between the three of us. We do a lot of consulting on this. It's really hard for G2, right? Coming in and trying to take over and trying to buy the business. I think there's just some quick economics to be worth
let's
showing
do it.
these people.
Because it is a conundrum.
Let's talk about this. Yeah, this is a great slide to look at. And again, going back to that, call it 4 to 7 times EBITDA range. And I know I mentioned that that's what you typically see in the independent space in an arm's length transaction. And then I also kind of spoke out of both sides of my mouth and said the average multiple being paid now is, call it 8 to 9 times EBITDA. Well, let's talk about why that's problematic, specifically for a G2 advisor that doesn't have a practice of their own and have cash flow to essentially supplement their income if they're trying to stretch in terms of valuation that they're paying. And I think a great example of this, and going back to that P&L we talked about, let's say you've got $1 million practice with, call it a 65% EBOC margin after their operating expenses, platform costs, and so forth, and they're running at a $400,000 EBITDA margin, which assumes that they're taking home $250,000 in compensation for doing the job of financial advisor, very competitive. And then ultimately they're reaping the benefit of the investment in their time that they've made, that ROR, to use your word, but the time and effort and energy they put into the practice and the risk they've taken in standing up the business, they're making that profit of $400,000. Well, assuming that profitability is what they have available to service debt, and we start to look at, okay, if they were to go and borrow on a 10-year term, these different multiples of EBITDA. So let's say we looked at a 7x multiple of EBITDA. Well, that's a 2.8 times, so $2.8 million. If they were to finance that on a 10-year term, ultimately at a 7% interest rate, which is probably lower than we're seeing typically right now, well, guess what? They're paying 100% of their EBITDA towards debt service. And that might be palatable. But when you start to creep up into the 8, 9, 10x range, that's not palatable. And they start to be underwater. And I think this is what most G2 successors are starting to see and feel, is that ultimately they're not able to afford market multiples for these businesses. And in many cases, these successors are going to bed on Friday night, the heir apparent to their practice, and in some cases waking up on Monday morning, an employee of a large-scale roll-up.
Mm-hmm.
Yeah, we have friends that have literally gone through this process, and it is difficult to see them go through it. And I think one of the things that we're particularly passionate about is trying to find ways to help them solve that problem. I think this would be a good point in time to maybe talk about how the concurrent model and what you've structured might help solve this problem and what it might look like, because this is a place that we consult on a lot.
Sure.
So, maybe walk us through what is the concurrent model, how is it structured, go from there.
Well, we talked a little bit earlier of kind of where Concurrent fits in the spectrum of it being high autonomy. At the end of the day, we want to be a platform for and strategic investor in independent wealth management firms.
Sure.
And so, platform first and foremost is ultimately what we wake up, eat, sleep, breathe, and think about every day. This is how we're serving and supporting our advisors in being able to best serve their clients. And this is things like operations, technology, compliance, and supervision, all the table stakes things that need to be done. And then being able to bring to the table things like planning resources and central services and fully open architecture investment platform and access to alternatives and so forth, tax planning, estate planning tools and resources. So, and that's really where we're able to put our advisors in a position where they have the mega firm resources, but have the competitive economics to be able to run their business and do so in a framework. We talk about this idea of advisor centricity, right? That clients gravitate towards their advisor because they're like-minded, they're best equipped to serve their niche. We truly believe that we'd be doing them a disservice to try to disintermediate them from their client or work them to some level of conformity. So open architecture is the name of the game in terms of our platform offering. But we also recognize what's going on in the space and the amount of capital that's coming in. And we also would be doing our business owners, our entrepreneurs, a disservice to not give them a place at the table, especially if we have the ability to access it. Sure. And when you look at what drives valuation, it's really scale, diversity of revenue, alignment, growth. Those are all things that are key drivers to valuation. And so, and go back for a second to that bell curve of valuation outcomes, because I think that's a good example. Again, if most practices are transacting now at 8 to 9 times EBITDA, if they're in the independent broker-dealer space, maybe they're still transacting in the 5 to 7 times EBITDA range because it's dependent on debt in order to fund those transactions. If you look at the far right side of this curve, right, call it less than 4% of firms are transacting above 12x. What we as a firm, our mission is to do is to be able to open up that door, give our advisors a place at the table, where they can achieve multiples on the far right end of this curve, that 12 to 15x plus range, because we can, without having to give up control to get it. Sure. And I think that's a unique outcome that we're able to create through our model. And so when we talk about platform and partnership, the platform piece, again, is how we come alongside and help our entrepreneurs operate. But the partnership structure that we have, where we take small minority investments in our advisors' businesses who choose to participate, completely optional. They're not obligated in any way to do it, but they have that option on the table. And many use it, again, to de-risk, facilitate internal succession. We'll look at an example of that in a second, but also fund growth. We have a lot of firms that are actively engaging in inorganic growth strategies that need capital to do it, that have exhausted their ability to access debt because they have to be competitive in doing these deals on a repeatable basis. And so that could be a phenomenal use of it as well. So within the partnership side of our business, we take a small minority equity stake in their business. They get cash and equity in our business. And they also get tag-along optionality, essentially an option to be able to sell alongside of us in any future recapitalization event. So if we're able to go out and realize those multiples, which when we started this back in 2020, 2021, it was more of a matter of if we get to this scale and if we do this. Now at the scale that we are at, it's a matter of when. but they're ultimately given an option to tag along with us. And really what we're trying to create through that option is a mechanism to continuously access liquidity out of their business at elevated multiples. And we've been able to successfully do that. We've given our advisors access to the window multiple times at this point. And so, we feel like we've got a phenomenal mousetrap that really threads the needle between creating the alignment necessary to create multiple expansion while still preserving the autonomy that our entrepreneurs want as they're operating their business on a day-to-day basis.
Sure. Dave, when you hear all that, what are some of the key sticking points that you hear from sort of the model that Concurrent's built? What makes it different and unique from your perspective, and how firms navigate those growth decisions?
Well, I think understanding the tag along piece is not something that is overly intuitive. So
Sure.
recognizing that that's part of the opportunity, recognizing or being made aware of the flexibility that they may become a part equity owner in your business or they may not. Recognizing, as we keep talking about, the broad spectrum of multiples that are out there and what the differences are. And even in the relationship with Concurrent, the initial buy-in is more of a 5 times multiple, and it's the later tranches that would or could be or would be, depending on the timing, right, at 2 or 3 times that potentially. So back to everything being so bespoke, each situation is unique. I think most of you aren't aware that these options even exist. And so that's step one, is starting to avail yourself, educate yourself, recognize the potential value of what you've built and are continuing to grow. That's what I think is most important for all of you at this point, because the right fit with an organization like this is going to completely change the entirety of what you've built and where it's going to go from here. Both are important. It isn't just grabbing value, grabbing payout, and grabbing these higher multiples. It's what's the landscape going to look like 1, 3, 5, and 10 years from now? And back to positioning and portability, are you tilting your sales in a way that's going to leverage that?
Sure. Well, and to that point, we have a lot of case study examples of this in a white paper that's uploaded as part of the portal here. It's called A Smarter Path to Liquidity, where we can talk about how, accessing liquidity in your business without giving up control can, in many different scenarios, help you grow your business and tackle this G2 problem that we spoke about. Would love to get into a specific example because I think it would make sense here to kind of see how it goes through. The big question is, how can this seller avoid sacrificing value so the G2 could buy in, right? Not go broke doing so.
This is the big question. It's the elephant in the room. Absolutely.
Yeah, it is. And it's honestly every young person I talk to, has the same question. So we have a detailed example of this in the white paper, but Nate, go ahead and walk us through this scenario.
Yeah, well, it's actually a consulting case that you've worked on, where I'll call it the founder of the firm has had a G2 advisor on the team for over 15 years. One of their primary concerns was they want to put them in a great spot. They want to set them up for success. And so looking at the quick practice profile, $2.5 million of gross revenue on about $300 million of assets, as I mentioned before, there's this seesaw that exists when it comes to succession planning. And it still exists in this framework. When we're going to talk about how this can impact that. But necessarily, for the seller to maximize value, it's going to detract from the buyer, right? And vice versa. For the buyer to have more cash flow, it's going to detract from the proceeds that the seller receives. What our solution, I think, provides is the ability to really raise the seesaw, to expand kind of the art of possible in terms of valuation and create a win-win where the seller can get like or better proceeds and the buyer ends up with more cash flow and less risk in facilitating the transition of that business. And so in those conversations and talking with the founder of the firm, we asked the question, what do you think is fair value? And remember, their goal was to set the buyer up for success. And they came back with a 2.5x gross revenue. Great, easily achievable. You could fund this with debt service. Let's look at what that could look like. And even willing to finance it at a very accommodative rate.
On a seller's note at 4%. Yeah.
Exactly.
Yep.
And so what we started to look at was, okay, let's play this out. So if they pay you, $6.25 million, You've got this debt service. What does that represent from an annual debt service standpoint for the buyer? And it came out to just over $1 million a year, or about 42% of the gross revenue of the firm. And again, those are fixed payments. And so if there is a market downturn, really there's no insulation there. They're paying those debt service payments over that time frame. When we started to look at, okay, well, how could we leverage our model where we can come alongside of that buyer as a co-investor to help subsidize the transaction? And so we started to look at this combination of an initial buy-in where we would come in and buy 10% of the revenue of the business and pay a 4x multiple in that transaction, and then ultimately allow them to exercise their tag-along option alongside of us in a future sale to sell. And what we were trying to solve for was, how do we get the seller the same $6.25 million bucks? Mm-hmm. And when we did that, the combined transactions between the initial 10 and the tag-along number, ultimately where they needed to get to was roughly 25.5% of gross revenue in those two transactions in order to achieve the same level of proceeds.
Sure.
Well, where does that put the buyer on the back end? Well, okay, at that point, 25.56% of the revenue of the firm's been sold. So they still maintain ownership of 74, almost 74.5%. They have full operational control of the business. The capital has been, injected from an equity standpoint. There's no debt service. It's common equity, so it ebbs and flows with the practice. But in that scenario, we freed up significantly more cash flow. And that was important because in the seller's absence, the buyer needs to staff up. They need to add another advisor to the mix. They need extra support in order to fully take on and maintain the service level on the book of business. And so this is an example of how, because us coming alongside as a co-investor effectively raised the seesaw, allowed the seller to get comparable proceeds in a scenario where the buyer ends up with more cash flow and in a better position, more insulated from risk and better equipped to continue to reinvest in the business.
Yeah, love that. I think when you start to look at these solutions, and Dave, you had said this earlier, I think it's important to know that your partner in this should help you really understand the economics of your business, really understand what important levers are there to pull so that you can come up with a solution that helps all parties. And this is just an example of one of the many ways to do it. Dave, anything you want to add before we start to wrap up here? Maybe give some information about Concurrent, how to reach us if they have questions like this. Just anything else you think is important for them to think of as they assess, measure, decide.
Yes. I mean, even a couple of my consulting clients that I'm talking to about this, and they're going through some of these machinations now. It's just a challenging environment. They want to do the right thing. Sure. And in most cases, it's a generous seller that is making these things work. Yes. And unfortunately, I'm okay with that. I think we're all okay with that because we know these businesses need to transition. But what I don't want is an uninformed, generous seller that isn't aware that they could have the best of both worlds if they're, availing themselves of some of these different options that are available to them. That's really the insight and awareness is so powerful and so important at this point. There's just so many out there that don't know what options are available to them.
Yeah, absolutely. And so as we wrap up here, some of you may have questions. We did have a question come in, so they do want to learn a little bit about the platform and the technology stack as well. I mean, you mentioned this earlier, big firms are in fact able to, create these amazing platforms that have a bunch of solutions. Yep. Let me put it up here. Yeah, we happen to have a slide on it. So glad you asked the question. Nate, you want to talk a little bit about Concurrent as a platform, as a business, outside of the partnership that we just spoke about?
Absolutely. And I think going back to why it's the right model at the right time, and the space being more accessible than ever, at the end of the day, as we work to construct our platform, we wanted to make sure that our advisors had the best-in-class technology, that they had full open architecture around their investment solutions that are at their disposal, that had full support around all the key areas that Dave mentioned earlier in client service, in planning and investments. And so, again, this is a kind of a heat map of the different solutions that we have built into our platform. Look, we've spent a tremendous amount of time and money over the last couple of years investing in our data infrastructure to make sure that our integrations are tight, single sign-on functionality across every one of these platforms. it's the same advisor experience across every one of our custodians, Fidelity, Schwab, Goldman. We do have broker-dealer capabilities through our relationship with PKS. And so what we're able to do is we're able to string together all of these best-in-breed resources to deliver a very eloquent solution for the advisor and for their end client. And what we talk about a lot as we're out there having conversations is that what partnering with Concurrent means, you're not joining our firm, we're partnering with you to build yours. Our mentality is serving you is the best way for us to serve your client. And so everything is really built to that end.
Yeah, love it. Dave, anything you want to add? Do you like the platform? You've seen it.
Yeah, well, it's working. And what I would add, you guys can answer the question, the average affiliate here is a very high-end wealth management firm, right? Yeah. $500 million. I mean, where are we at average affiliate now?
Yeah, we're approaching 300 million on average.
Okay.
And again, a number of billion-dollar-plus teams have come on board.
And the pipeline has a lot.
It's continuing to expand.
Yeah.
Well, I think to that point, the robustness of the team, the layers, the ensemble nature of some of these teams where they're not brand new advisors. Their advisors have spent years really curating their particular client base, and they've got specialization and niches, and they're looking for higher and bespoke solutions. So in a way where we can attract the people that not only are ready for a platform like this, but are entrepreneurial in their mindset, they get such a great fit. So, I have obviously we're, want to be safe here. We've got all of our disclosures out there. But if you are interested about learning more of the options, obviously info@poweredbyconcurrent.com. There's quite a lot of links in the On24 site for you to click on, to message these guys directly. Joseph Mooney on LinkedIn is the head of our business development. So we encourage you to talk to him. And then, of course, you can reach out to me if you have any questions as well. But guys, under an hour, I'm impressed by us. Thanks for being here. If you want more of this content, if you want to hear more sessions like this, and if you want us to go deeper on any of these topics, just let us know. And we'll host another one of these. So thank you for attending, and have a great rest of your week.
Thank you.
Thank you, guys.
Thank you. Thanks, Liz.
Bye.
Thanks, Nate.